What's up, guys? Welcome back. This is going to be a part 2 to last week's video when I did the difference between buying and selling call options. This week we're going to talk about buying and selling put options. What's the difference and what does it mean to buy or sell a contract versus buy or sell shares? Let's dive right back into it. So first I'll give you the technical definition, and maybe this time we'll start with the analogy that I used in the call video and then I'll apply it to stocks. Kind of go in reverse this time and see if maybe if I put it into perspective, then apply it to stocks, you'll be able to do it that way. But first, what is a put option? It is the right, not the obligation, to sell 100 shares of an underlying asset at an agreed upon price anytime before or at expiration. And there's a couple things here. Different than the call option that we looked at last week. In a call option, we have the right, not the obligation to buy 100 shares. Now, in this case, we are going to be selling shares at a given strike price, and we have to see that this part has to be agreed upon. There's going to be two parties in every contract that is either written, sold, or bought and held by us. And if you haven't seen that call video, I'll link it down. I'll pin it in the description in the comments. You could check that one out first. I don't really think you need to know that one to know this one. You should be fine. But first, let's take a look at something that maybe we can wrap our minds around. Something that's not as confusing as options for the beginners. Say I own a house. It's a little house right here. And right now in New York State, even though it's little, it has a value of $300K. Right now, the housing market, we know everything is overinflated. I know I want to sell this house and I know I want to move, but I don't have a place to go yet, right? Everyone's talking about the value of their homes. I don't know where I'm going to go. So I need a little bit of time to look for a house, maybe a year. But with the current market, I'm watching all of Graham Stephan's videos every day and everybody meet Kevin, and I know that there's a bubble, right? There's this huge housing market bubble, and I'm pretty sure that in a year, the value of my home is going to be less than it is now. I want to sell it now for $300K, but I'm pretty sure in a year it's not going to be worth that. So what I might do is I might maybe take out an insurance policy. I might call somebody up and say, hey, can I sell my house to you for $300,000, but I can do so in the next year or so? And that person says, yeah, okay, that seems pretty reasonable. I don't think it's going to go down that much. I'll let you sell it to me for $300K in a year. So right now we have two parties. We have me, the seller of the house, and somebody else that wants to buy it. So now a contract needs to be made between me, the seller, and then the buyer. And if we think about who's taking on more risk, more unknown, well, there's really no place to put the risk, which is why both parties are willing to enter this contract. Both of them think the risk is on the other person. Me, I think the risk is on them. I think the housing market is going to dive and they are going to have to take this house for $300,000 when it's not worth that much. Or they think the opposite. They think in a year the value is going to go up. It's going to stay above $300,000. And what they're going to do is they're going to get to buy a house that's more expensive for $300,000. So it's all the viewpoint of who you are, whether you are the buyer or the seller. But the buyer here, they're not that crazy. Like they've read the news. They know that there's a little bit of risk on our end. So what they do is they say, hey, I will agree to buy this house for $300,000 between now and a year from now, but you are going to have to pay me to write that contract, right? I'm going to need a little bit for my time, for my risk, right? If you have an insurance policy on your house, you know that you pay premium for that insurance policy. Whether you use the policy or not, you have to pay premium. Well, the same would be held true here. Maybe I would give them $50,000. Then I go out, I look for my house, I find my house maybe in 6 months. The market goes down a little bit, just like I thought, it goes down to $200,000. Boom, I get to sell for $300,000 because of the contract that I had between the buyer. Now, here's where things get a little bit confusing when it comes to options. I used words here like buyer and seller. Right? I said that I was the seller and this person was the buyer. Now, this is where we have to separate buying options contracts and buying and selling actual assets. In this case, this buy and sell was of the asset. We were going to buy or sell this $300,000 house. But the contract that was made between us is very different than that asset. And that's where I'm going to start to relate it to stocks. So in this example here, I'm going to use the seller of the put and the buyer of the put. The put contract is not the asset. The asset is going to be the stocks inside that contract. So let's look at the seller of this put contract. They make this contract and they are the seller of this put. They say, I want to buy 100 shares of a stock at $20. And because they have to put some terms on it, some expiration on this contract, they say, I'll buy the 100 shares for $20 before Friday. Now, what is the belief of this person? Well, they think the share price is going to go up. If it's currently trading for $19 and they're pretty sure it's going to go up by Friday or even next week, by Friday it's $25. So now what they're going to do is they're going to get to buy 100 shares for 20, but they're really worth 25. That's a good deal for them. But they need a counterparty. They need somebody to buy that contract from them. And that's where the buyer of a put option comes into play. They say, hey, I'll take that deal. They say, I'll sell you the 100 shares for that $20. What do they think is going to happen? Well, what they think is going to happen is that share price is going to go from $19 down to $10. Now they're going to get to sell their $10 asset for the contract price of $20. They are going to win in this situation. Now, for the right to hold that contract, when you buy something, you have to pay. So to make this contract or to complete this transaction, the buyer needs to send some premium, what we call premium, over to the seller of, say, $8. So the seller gets $8 of premium. They're the seller of the option. They wrote that option. They sold it. When you sell something, you get money. We call this premium. We put it in our pocket. Boom. End of the day. The buyer, they have to now put that $8 aside. They have to give it to the seller as, the right to be able to exercise this option before expiration. So let's separate the words buy and sell, because that's the real point here. If we look, if I am the seller of the put is the contract. I sold the put, but that was to buy assets, right? When you are the buyer of an asset or the buyer of a put, you are going to buy that contract, but you are going to be selling 100 shares to that particular person. Now, in the world of my Discord and the wheel strategy, this over here is most commonly called the cash secure put, right? You put the money aside to buy the 100 shares as collateral, and if you get assigned, you have to buy those 100 shares, right, with the collateral that you put aside. Where when you buy a put, you just have to pay the premium. That's the maximum amount of money that you can lose. Now, it's worth noting, this is not the same as short selling. That is a completely different video. If you want me to do a short selling video, that's kind of what you're hearing with the short squeeze with AMC and GameStop and all these things. If you want me to make that video, I will. This is completely different. But please, guys, understand, because so many people tell me in my Discord, they'll be like, oh yeah, I bought a call, but they're talking about, a covered call, where that's selling a call. Please know the differences between buying contracts and buying and selling assets. Now, I mentioned max loss, like who can lose here? Who has more risk? Are you at more risk as the buyer, or are you at more risk at the seller? I think, and this is how I feel, this might be my opinion, it might be fact, I don't know. For me, as the seller of a put, I have more defined risk, but my overall financial risk is probably greater. Where when you are the buyer of a put, your probability of profit is lower, but your max amount of financial loss is going to be less. And here's what I mean by that if I show it on the graph. If this is profit and loss, and this will be a rough sketch, guys. I've done this sketch 100 times, but I kind of just want to show you. And you are the seller of a put. The most amount of money you're going to get is the premium that you collected. So if right here, this is the strike price of $20, our profit can only be $8, what we collected. And that is if this expires worthless. And this contract is going to expire worthless if the share price stays above the strike. So this is $8. Anything less than that, we could incorporate some loss. Because if we have to buy 100 shares at a price of $1, that's not good for us. Because if we have to buy 100 shares at $20 and the current price is $2, that's not a very good deal for us. So as the seller of a put, you want the price to stay high, you want this to expire worthless, and you want to keep 100% of your premium. That is essentially your goal. Now this quote loss down here isn't money that's going to come out of your pocket. It's just capital gains lost. You will now be stuck with what you might hear as bag holding. You might be stuck holding a $2 stock that you paid $20 for, and now you have to hold on to that, sell more contracts. You might be in a little bit of hole. You have to wait for this $2 stock to get back to $20 to break even on it. Not really a good position to be in. I don't really love to sell puts, to be honest with you, and it's for that reason. I got burned by Wells Fargo a while ago. It was flying high. I put in a strike price of I think $30, and it dove to $18, and it stayed there for months and months and months. It took me forever to recuperate my losses by collecting all this premium and lowering my adjusted cost basis. So that's personally why I don't like selling puts. So now the buyer of the put, what does their profit and loss look like? Well, their max loss we talked about is the premium that they paid. And that happens if it expires worthless. It stays out of the money. It stays above $20. So we see that down here as an $8 maximum loss for the buyer of this option. Now, unlike a call, remember when we bought a call from that video, as the price could theoretically continue to go to infinity, we have unlimited profits. As the buyer of a put, that's not particularly so. One of the reasons I don't really buy puts either, I kind of stay away from puts altogether. There is a defined profit because we profit as the share price dips down to zero. And the share price can only get to zero. So what we see here is if this gets to $0 strike price, that would be the maximum profit as the buyer of the seller that we as the buyer of the put that we can actually get to. What happens in that scenario? Theoretically, it's never, company's really never going to get to zero. You probably shouldn't be messing with companies you might do so. Look at crappy companies like Nikola, right? That's not even at zero yet. And if any stock should be at zero, it's probably that one. But here's essentially what just happened. We just sold 100 shares of a $0 stock for $20. That's a really, really good deal for us. So unlike when you buy a call, there is a defined profit zone. And that defined max profit happens if the share price were to go down to zero. So the long and short, guys, is you buy a put if you think the price is going to go down and you want to sell it for a higher price than you think it's going to be later. And if you are the seller of a put option, you're going to pick a strike that you'd be willing to buy 100 shares at and hope that it stays above that price so that it expires worthless. You just keep the premium and you're good to go. This is also in the cash secure put side, the part of the wheel strategy, guys. I hope this helped. If there's any more introductions to things or things you want me to explain, please, that makes making content super easy for me. Leave them down in the description below. I'll put up that call video from last week and I'll put something else all around somewhere on the screen of things that might be relevant. Maybe the options, playlist that I have. And until I see you guys in the next one, stay positive, work really, really hard. Please be kind to other people. I hope you have yourself an amazing day and even better tomorrow.